Can you guess what types of lenders have the most loans outstanding for the commercial real estate or just commercial lending as a whole? Well, I'll let you know here pretty soon. I'm going to be unpacking the 4 categories of commercial lending today. They look like C&I, CRE, which is commercial real estate, SBA, which is Small Business Administration, and equipment financing, with the intention of showing you outstanding balances in each sector and what is going on with the growth and how it's going to pertain to your financing success. So before we dive in, you're going to hear a lot of different numbers, trillions and billions. Let's just unpack that for just a minute. Driving 1 trillion miles would take you around 167,000 years. If you drove at 70 miles per hour non-stop, you'd circle the earth about 40 million times. So just let that one wrap in your head for a minute. Now, why does this even matter to you? And first of all, is to help you align your expectations with reality when it comes to getting a loan, and then provide a reliable way to get your loan done. Clear out the chaos in your life and ultimately elevate your own vision of where you're trying to go. So I'm going to go ahead and pull up what it's going to look like as it pertains to this market. Again, remember 4 categories: C&I, CRE, SBA, equipment. 2.84 trillion outstanding loans Q2 of 2025. That's up about 2 to 3% as of Q2 of 2024. Commercial real estate, 4.81 trillion, again up 2.3% versus Q1 2024. SBA, small business lending, which includes 7A and 504 lending, 31.1 billion outstanding. That's up 13% versus fiscal year of 2023. That's a record breaker. So we're going to unpack that for a minute too. Equipment financing, 1.3 trillion 2024, up 3.1%. And that one also has broken some records. So we're going to unpack this together as we go through it. Okay, now I want to look at C&I for just a minute. There is a report that's outstanding, Senior Loan Officer Opinion Survey. It's really helpful if you know what that is and that you get access to it as well. In 2025 Q2, they said there was a modest net share of banks that tightened C&I credit standards for firms of all sizes, while there was a significant net share reported of weaker demand for C&I loans. Interpretation: story of walking through mud with some of my friends. Ultimately, think about this for a minute. When I went to climb into the Narrow Canyon, so it was right on the border of, call it Arizona and Utah, we actually went to the ranger station before, and I walked in there and I asked the lady, who's been there, by the way, for 20 years, I said, we're going to go down and do the Narrows. I think we picked the right time because it's not going to be raining or flooding, which is super dangerous. And she said, yeah, you're correct. There is one problem. When you go in there, you're going to be in the mud up to probably your knees and maybe even higher sometimes. Well, take into consideration, we were going to be in there with 2 of my friends for probably about 2 or 3 days. And I looked at her and said, thank you very much for the information. I walked out to my friends, and guess what I said? This is what she said. I don't think she really knows what she's doing, so let's go. Good idea for 3 young guys with not a frontal cortex that's fully developed. So we ended up going in there, and we were stuck in the mud, just walking slowly, trudging through this thing for probably about a full day. Great decision. FYI, don't do that. But the reason I bring that up is because it's similar to what we've been going through. Just walking and trudging through mud, everybody's going slower, the confidence is lowered. That's just the reality of our circumstance right now. The delinquency rate for C&I loans at the banks have risen only modestly, probably 0.83% of C&I loans, which is virtually is non-current as of early 2025. It's up slightly a little bit from the pandemic eras. Net charge-off on C&I loans have also inched up, but they remain below historical averages, roughly about 0.45%. in Q1 2025. Now, a little bit of this is deceiving just because banks can retool the loan in some ways to make it so that they can drag it out. They can recast the note if they want to. They can do some amendments, some modifications. But either which way, C&I is looking pretty flat. And I could just tell you right now, that's an area banks really want to press into. They also talk about increasing the loan loss reserves. So think about loan loss reserves as setting aside an amount for default risk. That's not cash necessarily per se. It's an accounting factor for the banks, but they really can't loan some of that money out, which means they're paying. Remember, you put deposits in, they pay on that, and that's costing them and going against their balance sheet, henceforth really the profit and loss statement. And it really makes the happy pants regulators smile because they know they have more reserves in there in case there's an absorption of default that takes place or a run on your money. So overarching, they're doing this, come but slow down, come but slow down. You're not quite sure what is going on there. So what does this mean for you? Look, push for C&I because banks want that right now. They want to dilute their commercial real estate that is on the portfolio right now. They want to enhance the deposits that are coming in right now. They're literally compensating and paying people that they're staffing to go out and just land blast for deposits. So you can take advantage of that right now and leverage that to your advantage. So if you have some deposits, you're going to have some deposits, take advantage of that right now. Plus C&I, if you need anything having to do with lines of credit, great time to go in and get those right now. Let's look at commercial real estate. There was a slow rise, but a rise nonetheless. Banks hold about 37% of the commercial real estate mortgages. That's shocking, a little bit more than a third of the loans outstanding. That's pretty darn big. Pressing into the banks now, it's a great idea to do it, even though most people might be running away. I think it's good preparation for the future. Originations were down, though, 35% for multifamily year over year. And then more equity is being demanded, stricter covenants, and then lower leverage. So you have a trifecta when you're going into the banks because they're just tightening in all areas. The delinquency rate is about 1.28%. That means they're 90 days past due. And the CMBS delinquency, take this for just a factor, 6.42% as of Q1 2025. That's up 5.8% from late 2024. So there's a lot more distress going on there. Life companies, they're under 1%. Super conservative. Office is the pink elephant in the room. This is what's causing all the turmoil and issues. Those are the things that are selling in the secondary market. And the banks are favoring existing customers right now. So for you, again, this is all about relationship expansion time and forward thinking. Do 6-month prep work now. Build those communities out, build those relationships out, expand them right now. Do all your legwork right now because it'll pay off. In your microcosm of world that you've done, you've got to go broader, you've got to go wider in order to have success. SBA, remember Small Business Administration? I call it Rocket Man. It's a great song, by the way. It is launched 70,000 loans, $31.1 billion in the fiscal year 2024. That's up 13% from the fiscal year 2023. Higher conventional rates right now is part of the push into that and just stricter underwriting. Smaller boomed about 81% for everything that was less than $500,000. That's all the money kind of went in that place and just shot up for anything $500,000 or lower. Historically, they have higher default rates. In the fiscal year 2024, mid-single digits. Look, SBA financing is really interesting because banks, institutions, that they don't have to absorb all of that risk. It gets off-put by anywhere from 50 up to 80%, where someone buys that note. They make a lot of fees. They get them on their bank. It allows them to get origination fees. There's all sorts of reasons why banks want them. They're willing to book them more. They just henceforth have a little bit more loose underwriting. And I say that really with a trite thing because there's no such thing as loose in a bank. But nonetheless, that's an area that they're thinking about increasing the cap from $5 to $10 million. I'd say lean in. If that's an area you think you could take advantage of right now, it's a great one. And I think liquidity is going to be there for a while. It's an area that if you are in the small business administration area, it's a great area to go as well. Equipment, all-time high. It grew 3.1% as of 2024, record 123 billion in originations in 2024, slowing a little bit in 2025. The rising equipment prices are part of the factor. 98.7% accounts were current, so very low delinquency rate, but rose maybe 0.67% in 2024. Mid-2025, 2% delinquency, and the credit approval rates jumped probably about 78%, the highest in 2 years. So for you, lean into this area for growth. All of these different areas, like I said, equipment financing, C&I, commercial real estate, SBA, it just gives you a snapshot so that you can realize at the end of the day, for you as the person that's trying to get stuff over the finish line, you want to be in a position where you can slow down and clear out the chaos and ultimately elevate your own vision. This is your report for commercial real estate loans outstanding.